Welcome to the IndiaFintech Diaries, the only podcast focused exclusively on the Indian fintech market. I'm Elroy.
And I'm Hemant. In each episode, we dive into the latest trends, ideas, innovations, business models, and personalities that are shaping India's fintech landscape.
We also invite amazing guests who are innovators and industry players that are driving the change that is helping make financial services more modern, innovative, and inclusive in India. Come join us as we explore the changing landscape of fintech in India.
Welcome to India FinTech Diaries, the show for all things India FinTech. I am your host Hemant.
And I'm your host Elroy. Co-branded cards in India boast of a rich history beginning with the launch of the first co-brand cards in 1997. Since then, they've been seeing consistent growth and have transformed the credit card industry with customized benefits and rewards. To delve deeper into this topic and to understand what the future of credit in India looks like, we're joined by Ramanathan RV, co-founder of Hyperface. Welcome to India FinTech Diaries, Ram.
Hi, Elroy. I'm Hemant. It's good to be here.
Absolutely, Ram. We are really happy that you have found time to join us today. So, Ram, you have had a very long association with the world of fintech. So, can you tell us a little bit more about your background and how you came to found Hyperspace?
Sure. Yeah. See, I have my background is engineering. I started my career with Amazon. Right. This was way back in 2006, and this was also the time when a lot of the first wave of startups were being founded, and amongst that, of course, the most famous one, Flipkart. Right. Sachin and Binny also
Right.
used to be at Amazon at that time. And I joined a startup based out of Chennai called BankBazaar.com. This was in 2008 when the word fintech was not yet discovered at that point in time. It was not that in vogue, right? And this was again, if you can remember, this was during the recession time, right? And
Right.
we chose a problem and we were trying to solve that for some of the banks in India. This was in 2008 to I worked till 2011 in that company, and then I started JustPay. This marked my transition from being a very technology focused person into getting into the world of digital startups and entrepreneurship, right? And this was again, I would say, was the golden period for e-commerce, right? Because it was just growing, and there were tons of issues in payments, of course, digital payments, right? So I transitioned essentially from being a full-time technologist into an entrepreneur, but we were still, it was a technology problem, and we solved it as such, right? And that journey took me into the world of UPI, built the Beam app and helped launch that one for NPCI. And ever since, have been involved in UPI for various different initiatives, right? And within the company and outside the company. And in 2019, I left JustPay, and 2021, I started Hyperface with a focus on credit cards. Because credit cards are growing at the moment, and again, we're seeing a bunch of problems. Every time we see a problem, it almost always looks like an opportunity to us, right? and
Right.
and here we are in 2024, in the middle of all things happening in the fintech industry today.
Ram, actually, Elroy told us that co-brand has a very long history in India has been doing remarkable. In our team, Elroy is our in-house card expert, and he tells me that the first oil company focused co-brand was launched in 1997, and from there today co-brand represents about 30 to 35% of new credit card issuances in India, and the growth rate has been exceeding 14% CAGR in spending. Now, this evolution reflects a significant stride made in the co-brand sector. So, being an expert in this space and you're running a company in this space, can you walk us briefly through the history of co-brands in India and give us a sense of what is the opportunity size like and the scale for this particular business opportunity?
See, the difference between a debit card as a payment instrument or UPI versus a credit card, if you see, right,
Right.
it combines the elements of payments and credit very nicely, right? And because there is the margins that gets plugged back as rewards, right? So it combines elements of rewards, loyalty, payments, and credit all packaged under a single instrument, which is blessed by the regulator, very well
Yeah.
understood by the customers and the banking ecosystem as well, right? So that's what makes it extremely fascinating. Think of it as a multi-dimensional product rather than a mono-dimensional, just a payment method, right? Now, when you look at it that way, you can see that, okay, why is there a pull for a customer, right? A customer may only have one debit card for a bank account, but with the same bank, a customer may actually take three, four credit cards as well,
Right.
right? Which are meant for different users at different points in time, right? And that's what makes it extremely fascinating as a product, right? Now, if
Right.
you look at, of course, as a overall ecosystem, what is the goal? It is to drive digitization, right? And instead of physical cash, we want the customers to use digital payment methods, right? So to that end, the pull for a customer is always, it's not that, okay, you know what, this is a digital payment method, you can use it in place of debit card. That's not an interesting story, right? The
Right.
story that we tell to the customer is that, look, here's the benefit for you if you use this particular card instrument, right? This particular payment method, right? You get some cashbacks, you get rewards, you get priority access to something, right? It can be any of that kind of a perk or a benefit that can be packaged into the card, right? And if you see from a bank's point of view, which is the institution that gives you the plastic, right?
Yeah.
They are not an institution which understands the various day-to-day needs of a customer, right? They are the guardians of our money first and foremost, right?
Sure.
Now, when you combine this with a shopping behavior of a customer, right? Look, you go to this grocery stores on a regular basis. Why don't I give you something for using this payment method? And here's the card which has an association with this grocery chain, and you take it and you use it, you benefit out of it, right?
Sure.
Then that story is really, really powerful, right? And ultimately, stories is what sells with a customer, right? And that idea is a very powerful idea, and that has actually caught on in the entire world, right? We're talking about
Right.
India today, where 1 in 3 credit card is a co-branded credit card. But you look at the US, a very evolved market, nearly 45% of issued cards are co-branded credit cards, right? That's like close to 1 in 2 credit cards are co-branded credit cards.
So Ram, you brought some very interesting points in terms of the use of a co-brand card from the perspective of the consumer. But I'd also want to look at 2 or 3 other aspects of it. So first of all, what are some of the advantages that co-brands could offer to brands that issue them? And secondly, if we take a look at the issuer lens, can you highlight some of the ways in which co-brands offer better performance metrics as compared to regular cards for issuers or banks?
So there's some bit of history to this when you think about it.
Right.
You look at the way we used to transact before digital, right? It isn't cash, right?
Correct.
So when you look at the shopping behavior of a person, right? You go to a grocery shop, and then the store owner welcomes you because he recognizes you, right? And then you purchase your grocery, and at the end of it, you give cash, right? Now, if the store owner is not there, and if the attendant is there, or if an employee is there, they may not even recognize you, right? So it's a very anonymous purchase that is happening there, right? Maybe if the store owner was there, he could have given you a repeat customer discount, right? For the
Yeah.
goodwill and for the loyalty, right? So the world of cash is completely anonymized, right? And when it becomes digital, imagine today we have mobile phones and all of that, but in the absence of a mobile phone, the only way to identify a repeat customer is through this payment instrument, right? Because that instrument is a centrally managed, issued by the bank, and the bank can recognize that you're a
Correct.
repeat visitor for this grocery chain, right? And can process your loyalty cashback or a reward point using that information, right? So that history is how you should actually see how the evolution of co-branded credit cards really became the most powerful way to deliver a loyalty point or a reward to a customer, right? A cashback to the customer, right? Otherwise, you would have to carry individual. I don't know if you remember, businesses used to give these
Loyalty
individual
cards. You
cards,
used to get these loyalty
loyalty
cards as
cards,
well.
right?
Yeah. Yeah. And quite often you forgot. Correct. You forgot the number also quite often. You didn't carry the cards. So you never got your loyalty points.
Right.
Yeah.
right? And in fact, this history today, even now, it is prevalent in the US. Apple and Google Wallet actually supports these loyalty cards,
Yeah.
right? So you can actually show those numbers, and you can get your loyalty reward, right? Today, if most of the hotel chains also use these separate reward numbers, but in the modern business where we're looking at extremely digital interfaces, right? These are unnecessary things. You can triangulate a customer using payment methods and mobile numbers, and you can deliver loyalty. So credit card is a very essential key loyalty delivery mechanism, right? And through this co-branded credit card, of course, what also happens is that the whole management of this loyalty program is then offloaded to the bank
Yeah.
instead of every business implementing a loyalty solution at their end, right? Which is just unsustainable, right? Imagine tens of millions of businesses all implementing a loyalty solution, very expensive, right? While just we just have thousands of banks, and they can implement a loyalty solution, and that these businesses can simply piggyback on.
I kind of like the one statistic that you said that if you look at the US, right, you have almost one in two cards that is actually a co-brand card. And in some ways, we are in the golden age of co-brands. So, how have consumption patterns in India changed, which is now leading Indian consumers to start having a higher affinity towards co-brands? If you could share some insights on that as well.
Right, right. See, earlier also, you began with saying that we've had our first co-brand since 1997, right? We
1997,
did
yes.
have it,
Yeah. Yeah.
right? We did have co-brands. It's just that scaling and distribution has always been the toughest thing, right? And then also having really large chains, a very heavy concentration of customers going to a single place, right? Those all were phenomenon that was just catching on
Yeah.
in India. It used to be the oil marketing companies, and then the airlines, right? That's where it starts. Now today there are grocery chains, hospital chains, and pharma chains, and you find that okay, this is now having a lot of cluster and concentration, right? It then becomes viable to look at delivering a loyalty program, a scaled loyalty program to the customers, right? So that's one enormous change that we are seeing in the marketplace today. Every business, you look at coffee shops, for example, right? Where did we have these huge coffee chains outside of Cafe Coffee Day?
Right.
Today, we are seeing so much vibrant ecosystem of coffee shops, right? And large chains that are VC funded, companies that are coming up and building large chains, right? So for them, then they can now look at building a very, very interesting loyalty program, right? And then rolling it out more in association with the credit card as well, right? So that is one huge phenomenon which is changing, where large businesses are being built, multi-chain businesses, right? These are really spread across the entire country, and then online as well, right? Online drives concentration like no other business,
Right.
like no other format, right? Because you can pretty much scale overnight if the customer likes, word of mouth, and then a lot of customers flock there, right? So that concentration is what is enabling today for such vibrant growth in this ecosystem, right? We probably would have had maybe 50 co-brands in the first 15 12 years of credit cards in India,
Yeah.
right? But now we see 50-60 co-brands being launched in within the span of actually a year,
Yeah.
right? And we only predict that this will increase significantly going further, right? Of course, in a hyper competitive market, will everybody survive? May not be the case, right? And that is a good thing, because it should be a true marketplace, and the customer should vote with their wallet as to who is going to survive, right? But we are going to see a huge explosion of co-branded credit cards.
Ram, I have a question purely from a customer point of view, and I may be, pardon my ignorance on this, but you just said that now the number of co-branded card being launched are massive. Do you expect a fatigue being set in, considering, for example, take me as a customer, I will only take, say, X number of co-brand cards. If they go beyond a certain number, it's very difficult for me to anyways manage those many cards, even if in a digital form. So is there a solution being proposed, or someone is doing a solution where there is a clustering of multiple co-branded cards or some other solution to make it easier for the customer?
Okay, so it may emerge as a problem subsequently, but today this problem does not exist, right? And
Understood.
obviously there are various other forces at play here as well, right? We have this huge overhang of privacy as well, right? Which is a true
Right.
concern in the entire ecosystem. How do you make sure that every participant is responsible when it comes to data privacy, right? So unless I think this problem really looms large, right? There, I don't think there
Right.
will be any attempt to create a solution for this, right? And when I say that this problem has to loom large, what does it mean, right? It should mean that there is a lot of programs that are actually getting shut down because of inactivity and the customer not preferring to use them, right? And it dies a natural death, right? But today I don't see that today is that problem so acute. No, not today.
So, and you also explained, anyways, the importance of cards from the perspective of the brands and issuers. But whenever you look at any fintech market, the main curiosity that all of us have, if there are multiple parties involved, there's a issuer, there's a co-brand player, there is also a provider of the co-brand tech. What is the revenue model for the industry look like? And broad percentage ranges are fine. So if you can just help us understand and give insights on that, that would be helpful.
Yeah, today if you look at the return on assets, right, and now we're getting a bit technical, right? So
Sure.
if you look at all the banking products, credit cards still actually come up as the most leading one when it comes to return on assets. Of course, perhaps MFIs might actually beat it, but credit cards in the unsecured segment, that is the most profitable business for a bank, right? And it is not only important for a bank from that point of view, but it's also important from a brand building exercise as well, right?
Correct.
Because if it becomes top of the wallet, there is a recall value associated with it, and the status of that bank in the mind of the customer is elevated, right? So that intangible value is also there. So many reasons why banks invest in credit card business, right? And as long as that business remains profitable and is able to beat the secured assets within a bank will be okay to growing that business, right? It has to be still be a fine balance. You can't simply throw 5% cash back for every customer for every transaction, right? That is where a natural equilibrium will set in amongst the issuing institutions. But that profitability is there, it's baked in, and that is what is actually being distributed among the participating institutions, be it a co-brand issuer. In fact, if anything, a co-brand card can actually be more profitable for the bank if they plan it intelligently. I
Right.
will give you some examples here, right?
Yeah.
So, so when a customer is purchasing something, let's say we are purchasing grocery, okay,
Okay.
and think of it from a customer's point of view, right? I need grocery. I also need my shirts and pants, okay.
Yeah.
So suppose that I go to a particular business to purchase shirt, okay, and the grocery card gives me say 5% cash back at the grocery store. Okay.
Okay.
And the fashion card gives me a 10% discount on the shirt,
Okay.
right? In the eyes of the customer, that is me, it is apple to apple, right? What I'm getting as discount is pretty much a money back in my pocket, right? Now the customer is most of the time not aware that the groceries are a low margin business and fashion is a high margin business, right? Whatever is the discount that they've received, it pretty much is, they look at it as just savings, right? So what if, let's say, if you sign up for this credit card, the clothes store, right, the for your pant and for your shirt, that particular store is willing to offer additional 5%, and this additional 5% discount doesn't hurt them at all, because a clothes store typically has a 90% margin, right? If not 90, 80% margin, right? And they
Yeah.
can easily afford this, right? And hence the loyalty is, when you bake this into a card, and it's very easy for the clothes store to put that kind of money on the table, discount on the table, for ensuring the loyalty of the customer, right? And now if you see, the difference here is that for your fuel purchase it is impossible to go beyond 5%, but for the clothes purchase it is very much possible to go up to 20 percentage in discount as well, right? And for the customer, it all translates into savings, right? So what I'm trying to say is that the discount on the card in categories such as fashion can be brought to the table by the fashion company. It doesn't have to come entirely from the bank, right? And the economics makes most sense there, right, for the customer, because it's tremendous amount of saving for them, right? So don't just look at, okay, is it the bank that is actually putting all the cash back on the table? No, it is typically co-funded between the banks and the brands, right? Because the
Right.
brand also benefits from loyalty, right? This is number one. Number two, the biggest cost in involved in credit cards, amongst the top ones you would see, is the acquisition cost of customer,
Yeah.
right? And a open market acquisition even today is as high as 3,000 rupees for a bank, right?
Yeah.
And when you go to a co-brand partner, which can be a grocery chain or it can be a apparel chain, you get access to ready access to 1 million or 2 million customers, right? And this also comes to the bank at a discounted rate. Typical charge or typical money that the bank offers is actually one third, or sometimes it's even less, one fourth of what they pay for open market, by way of acquiring, I'm saying, acquiring the customer.
Yeah.
So the capex translates to opex mostly, because they have to pay for additional rewards. The bank has to pay for additional rewards, right? And that is okay as long as profitability is guaranteed. Because if you indulge so much in capex, the results actually may not add up, right? It's a much more riskier strategy than a co-brand led strategy, right? And if the program is intelligently crafted, like what should be the actual tipping point for the reward? Should it be 8%, 9%, or 10%, right? Then the results can actually be astonishingly great for the bank.
So, Ram, in this now it's very clear on the advantages or the revenue that a issuer slash bank gets or the brand. Within that, a player like yours, which is involved, which is helping both these parties launch a card, what's the revenue model for that player? Is it transaction based? Is it fixed fee, or there are some other elements? If you can help with that as well.
It's a mix of all what you said, right? There is usually a one time fee as well. There is a transaction fee as well. There is a milestone fee as well, right? So it's a combination of variety of things, right? And sometimes when there is an acute problem that is existing, at that time it can actually be pegged to other metrics as well. For instance, let's say, how do you improve the profitability for a bank? You can simply do a early repayment. Then the cost of credit actually comes down for the bank. Now, if let's say, if a technology player like us helps with the early repayments for a bank, then the bank is willing to actually pass on some of the benefit to us, right? So I'm just giving you one example, right? There are, because this is money business that we are talking about, right? So there are
Right.
multiple optimizations that can be done across the entire portfolio, and that opens up quite a few revenue opportunities, right? In fact, we ourselves are
Got it.
discovering, right, as we work more closely with banks, we try to understand what the problems are, right? Servicing cost is high, collections cost is high, right? And bringing down those costs itself translates into a revenue for a technology company like us, right? And the only thing that we bring actually to the table is the efficiency through technology.
A connected question, and this is some time back when I was having these conversations with players. If there is a say a co-brand or a fashion player which wants to launch a co-brand card with a bank, the bank has its own ops team, but sometimes it is already burdened with the existing customer base, and this will bring, as you said, a big base to at least target. Right, what gets acquired is a different thing, which means that you need to have a ops center, including a some few call center seats available. Now, if a brand is launching that, is there an option where that comes or can be bought by a tech provider, or it has to be the bank doing it, or the brand can set up their own to launch quickly? So is there an option of taking it, say, for per seat basis or something from a tech provider, or no?
See, all said and done, selling credit cards is still a very difficult proposition, right? And a
Yeah,
whole lot of times, even for banks, it takes years to master the art of selling, right? And to really think that, okay, a grocery company can actually sell credit cards, right? It might not be possible, right? Most of the
right.
times it is it in theory it can be said, but it's extremely difficult when it comes to execution. The moment of truth, that experience is very different than what we talk in the idea rooms, right? We see that there are very few companies. This is based on what we see in the ecosystem. Very few companies have actually mastered the art over a period of years with with significant investment. And amongst
Got it.
them, if I can name a few, you look at an Amazon, right? Amazon has really optimized it, but it has come at a significant investment by way of manpower and technology to understand customer behavior. Right? Another company that has
Got it.
done stellar work here is Bajaj, right? They've built this distribution machine, right? But many other companies do not want to actually expend that kind of money in deploying their own human power and technology to sell credit cards to customers, right? Rather than leave it to the bank, because the bank already has existing machinery, and you can simply rely on that machinery to drive sales.
Yeah, because Ram, I was drawing parallel from, for example, Policy Bazaar. When Policy Bazaar started, the provider was the insurer, and they used to just put a list on, and you used to click on it, and then it was passed on to the insurance provider, and they used to do the closure of it, so to say, right? Basically, calling and etc. etc. Over a period of time, Policy Bazaar set up their own base of call center where they were still doing the tech part also, and also doing some part of the sales and bringing it to the complete last moment, and of course charging more when they provide that service compared to when they are just drawing in leads. So just trying to draw parallel and saying insurance selling is also very complicated business. So is there a parallel between that and a credit card? So just it was a thought experiment, nothing else.
No, absolutely. See, in Bank Bazaar, during my time there, right, we used to do the same thing. We had a large call center people, right, ops people who would call customers and assist them in completing that application,
Right.
right? And without that
Got it.
assistance, our conversion rates used to be very poor, right? But I have seen the cost and the effort it takes to actually set that up.
And Ram, now this particular area or space, especially the credit card space, is always under the hawk eye of the RBI. And the regulations are changing, where recently they said that the co-brand should be limited to just marketing and distribution, and providing the cardholder access to the goods and services. Now, this has also impacted the way data is shared between the co-brand provider, the issuer. So, how do you think the choice of technology will impact that? And the second is the RBI regulation on consumer freedom for network choice of credit card is also right now very unclear. So, purely from regulation perspective, how do you think this evolving regulatory landscape impacts the co-brand space?
It's a very important question to answer, right? Could we? I think the place where the regulator is coming from, and this I'm definitely speculating here, right? Is that, look, we are still nascent in this entire business, where can we give open data access to any company into the banking ecosystem, right? Where these businesses are not regulated, so it's impossible to trace where all the data is flowing into, right? And even if you look at the account aggregator ecosystem, right, that is restricted to regulated entities only, right? It
Right.
cannot be freely given to commerce entities, right? So it's a very nascent ecosystem, and in nascent ecosystem, trust building takes a long time, right? And once we've built enough amount of trust in the ecosystem, then we can open it up more confidently. I think this is where the regulator is coming from, rather than taking a very casual approach or more confident approach, right? It's more of a, let's understand, let's learn, let's build confidence, and then we will take different approaches to, say, a simple terms and conditions driven, consent driven data sharing with commerce entities, right? Because ultimately what matters is user consent, right? If the user is trusting the commerce entity enough, then the data can be shared, right? No problem with that. It's ultimately users data. but here the regulator has taken a call on behalf of the user and saying that, look, we will not allow this, right? And I think that is okay, because with these constraints also today, if you see, has Amazon not been able to scale the portfolio to 5 million? They have, right? So with I think the rest of the ecosystem also can work with these constraints and still scale this up in a large, in a big way, right? So and that's what technology enables, right? Uh, you have to throw constraints and challenges to the tech ecosystem, and they'll figure out a way to make things work despite those constraints, right? It's not that RBI is saying that, look, digital companies should not even launch a co-branded credit card, right? But these are the guardrails, and within those guardrails you grow your business, right? And that is fine and fair. I absolutely feel that it is okay.
I'm keeping all this into perspective. I'm curious to understand what are some of the key success factors that are required to launch a co-brand. And I'm also kind of curious about how much does network choice really impact on how successful a co-brand program is.
Right. Okay. So even today, launching a co-brand is a pretty large exercise,
Yeah.
because quite a lot of things have to be teed up to get to the point where you can say that, okay, now let's press the button and issue the cards, right?
Right.
Lots of approvals, lots of considerations, lots of planning around what should be the program construct, what should be the fees, what should be the reward structure, right? A lot goes into this, right? And it's typically a 3 to 6 months long exercise. The
Right.
only good thing is that most of the banks have done it 50, 60 times, so they know how to do this. It's a process, it's a well defined process, and you just go through that process, right?
Right.
But it does not take away the effort that is involved in bringing this to shape, right? And that was the first question, right? It is a lot of effort. Agreed, 3 to 6 months is what it usually takes, right?
Okay.
And you had a second question in terms of the network charges, right? See, the network charges today are not a problem, right? If you look at again the economics of a credit card, the average spend on a credit card tends to be, even for a co-brand, it tends to be about 800 rupees, and
Okay.
for a non-co-brand card it tends to be a lot higher. It's upwards of 2000 rupees,
Right.
right? And at that transaction level the network charges are not a problem. If you look at if you contrast this with UPI, right, where the average ticket size can be as low as 150 rupees,
Right.
there the current network charges will start pinching, will start eating into the profitability, right? But when we get there, and I think uh, it's still a question whether we will get there, right? Because then the volume will increase significantly, right? And we'll have many other problems surfacing as well, because in today's scale and the cost structures within the bank, servicing is more expensive, like I said, and
Yeah.
the old legacy systems are more expensive. Scaling with them tends to take a lot of effort and a lot of money as well, right? And those all problems will start ballooning for the banks significantly, even where let's say uh, when networks are involved, look, you'll always know that there is a way to go back to the networks and renegotiate and
Correct.
revisit these pricing to ensure profitability, right? And for networks also, the at scale the cost structures tend to be more profitable for them, right? And hence they can actually sacrifice some of their profitability as well. Not sure whether they'll do, but I'm saying that a much bigger problem will exist for the banks by way of the existing cost structure rather than the network cost when the whole thing scales. And it's also a question of if the whole thing will scale, right? Because we have UPI today. If you go to a country that does not have real-time P2P, P2M payments, in the US, you go to a Starbucks, you will pay $4 for a $4 for a coffee.
Right.
Right now, $4 again. If you look at that, it's a very small transaction, right? In their economy, such a small transaction, right? And there the cost structure per transaction, if the processing fee is 10 cents, 20 cents, it becomes extremely difficult, right? And yet they have actually scaled the whole thing using just cards, right? 650 million credit cards, and the scale of number of transactions run into billions there, and the overall volume runs into trillions, right? And yet the cost structures have not been a problematic thing for them, right? In India also, I think we'll find a natural equilibrium there, and I that would be the network cost will be the least of our worries at that time.
Ram, you also touched on one very important point on the use of legacy technology at banks to issue some of these co-brand programs. And I remember you calling Hyperface as the card stack, which is more of a modern credit card as a service, right? So I wanted to
Right.
understand from a technology perspective, how does using something modern like a Hyperface actually help banks and issuers launch better co-brand programs? And what are some of the implications of technology choice on co-brand programs?
Yeah, yeah. So I'll answer this question with my experience at Amazon.
Right,
So Amazon and Oracle used to work very closely, right, from the early days, right? There used to be two servers, one server for application and another server for database, which was Oracle server.
right,
Okay, and Oracle was also a startup when Amazon had just started, and they had this friendly relationship, which through which Amazon was able to negotiate very cost-effective pricing licensing for several years, right? And that actually went into a couple of decades for cheaper pricing, right? And obviously Amazon grew, and at a point they realized that once that friendly pricing time runs out, Amazon has to pay a lot of money, right? But a
right.
tech company like Amazon took several years to migrate out of Oracle across the board, right? Thousands of teams migrating out of Oracle, right? And enormous effort, right? Now imagine banks, and a lot of banks out there, really large banks, not in India, outside India also, right? They still use mainframes.
Yeah,
Migrating out of those mainframes is a humongous effort, right? We're talking about hundreds of millions of dollars of effort, right? And nobody, and it also does not come without risk, right? It's a running engine, and you have to change that running engine. There's a huge capex cost that is involved, right? And there is this huge risk of transitioning from one system to another system. It takes enormous amount of effort to actually do that kind of an upgrade, right? And that is the same problem which exists today with banks in India as well, right? The legacy systems are sitting at the bottom of the stack, and
yeah,
a lot of processes are built around this. So even if a bank thinks that they have to change a legacy system, wants to change, right, it is enormous effort for them. Forget banks, even for tech institutions, right? I remember in my own previous company, such a huge effort to change from one database technology to another database technology, right?
yeah,
2 year long effort to rewrite one of our core payment systems, right? So legacy is a burden for everybody in the ecosystem. Banks are no exceptions to it, right? And the cost of legacy just becomes a drag on the balance sheet, right? uh, so so what we try to do is that we try to make that legacy system as lean as possible, right?
okay,
Take out more responsibilities from that legacy system. So this trend is called hollowing out the core.
yeah,
So the core is made really dumb, right? And then all the logic is sitting outside, right? And that logic is sitting in a much more modern system, and from there you just percolate information down into the core, right? And that strategy has worked out very well for banks to scale up their systems. If you see today, the UPI switches, right,
yeah,
are built outside the core system, right? And then the core system is the last mile of the last one leg of the API call that actually lands into the core system, and then the transaction is finalized, right? All the other logic is sitting outside. So that way you bring out most of the logic outside, which is what we are also doing here, right? When we talk about making a co-brand have a very real-time experience across all their logics around benefits and product delivery, all of that logic is sitting outside the core, and from there we, whenever required, we go to the core system and then pull out information as needed, right? And we keep that footprint to a bare minimum, right? That way the roles and responsibilities of the core system will shrink, right, rather than trying to replace, which becomes a multi-year effort.
Ram, this week, I think Ease My Trip went live with your services for running its program. Can you provide some interesting case studies on successful co-brand programs that you have supported in your stack?
See, we've launched it with Ixigo, Aditya Birla, Titan. Right, these are some of the co-brands that have gone live on our platform, right? And every one of them had interesting problems to solve for. I'll tell you the problem that existed for a really omni-channel brand like Titan, right? Where
Right.
you've got bunch of brands, each brand having website, mobile app, and stores, right? And each being operated by different CEOs with different P&L structures, right? And different target audiences. The customer that goes to Mia is different from the customer going to Tanishq, different from them going to iPlus,
Yeah.
right? And at all of these touch points, there's an opportunity for them to pitch a co-branded credit card to the customer, right? So here, if you see, unlike the problem that exists for an Amazon, where you just have to put banner in 10 different places and then you can drive customer adoption, here the touch points are just extremely different, and
Yeah.
each touch point could behave differently and could actually give different results, right? So we had to build a complete system where the attribution has to be given to every single touch point, and then the conversion has to be measured from there so that it can be optimized further, right? So this in itself is a gargantuan exercise when you think about it, and there are many such businesses that exist today. It didn't exist 20 years ago, but exists today, where we have a much more diversified structure. You look at even someone like a First Cry, for example, right?
Yeah.
It's they've got website, they've got app, and then they've got stores, right? And so they can drive adoption from all of these touch points, right? And then obviously they have to offer some kind of a digital experience to the customers to keep them aware that they have a loyalty card with them, the co-branded credit card, and then drive traffic further, right? They might have a weekend offer, they might have a specific targeted offer for them across different categories, and then they can drive purchases that way, right? So plenty of problems exist, and if you look at, even in case of Ease My Trip, it's a multi-bank, they have co-branded credit cards with multiple banks there, right? And hence integration with different banks and then optimizing that is quite a challenge in itself, right? Of course, what I said is that these systems, either you build it in house or you work with a company like us, right? And sometimes companies try to build it themselves, right? And
Yeah.
they are successful as well. For instance, Amazon built it themselves, right? And they are fairly successful as well. But of course, as we as a B2B company, we specialize in this, right? And we can drive better results for them at a much lower cost if they, as opposed to investing themselves. So that's the main value add we bring to the table for all these guys.
Understood. Just looking a little bit towards the future, Ram, what are your views on how credit cards will transform in the future? And I think more importantly, I also wanted to some views from you on what this transformation would unlock as far as SMEs are concerned.
Right. Today in India, credit card is still a product that is targeted towards a salaried class and
Correct.
slightly well-to-do class. Right? We still have a huge number of people who exist slightly below that. Right? We have about 35 to 40 million customers having a total of 110 million cards today, right? And this population is still a fraction of the working population in India, right? So, what does it take for us to actually take credit to, say, 300 million customers, right? And
Right.
that could happen over a decade, right? Uh, but the characteristic of the product or the usage changes as we take it to people who are earning less than 50,000, less than 40,000, less than 30,000, right? And can we still make the product profitable, right? How
Right.
are the current cost structures going to help us get to that level of efficiency? Right? So that's a big challenge. And I think that is where a lot of tech investment itself can actually help. But there is also the other phenomenon of credit line on UPI, which is a new offshoot from the UPI ecosystem, which can actually become a challenger to credit. So the shape of credit itself could change, right? Because delivering a credit line on UPI today is a much more cost effective proposition than a credit card. But it does not alter the collection cost or the servicing cost for the bank. That still remains the same, right? But the acquisition cost comes down drastically. There is no card
Correct.
of plastic printing and dispatching, right? So the cost structure is a bit different, and can we structure the product differently? Can we give a 15-day credit instead of a 30-day credit? Right. So those kind of experimentations I feel will happen in the ecosystem very actively now, right? And the regulator has also been quite supportive by not defining what the credit shape of the credit product should be, as opposed to credit card, which is very heavily regulated today. The structure of the product is very heavily regulated. Now, this is one phenomenon, right? I think, and here the objective is very clear: get a lot of customers to start using credit, and the target in a decade could be 350 million customers.
Sure.
The next phenomenon obviously is the SME credit, which is
Correct.
again, if you see, credit card is a very salaried person's product, right? It's a 30-day credit free period, and the cycle is monthly cycle. So most of the cases, as soon as your salary comes, you pay the credit card amongst all your other bill payments. It's structured that way, right? But for an SME, their cash flows are quite different. The inventory turnover cycle may actually be 10 days or 60 days or 90 days. In case of farmers, it tends to be 4 months also, right? Now, we can't throw the same product, the same credit product to them, right? Of course, we can fit of this salaried person's credit product to uh, some of the SME ecosystem, but not to all of them, right? And from their point of view, again, the credit has to be thought out differently, right? Can we do a charge card with different characteristics, or can we leverage credit line on UPI and structure the product differently? Can we do an end use monitored credit card or end use restricted card or a credit product, right? There are various challenges that exist, and of course all of this should work economically for the banks, right? Because banks from day one think about profitability, right? They cannot afford to think like, okay, because they're not VC backed investments, right? They have to show profitability quite early itself, right? And hence they'll structure the product in a way that it makes profitability brings profitability to the bank without having to wait for 5 years or 10 years, right? And so with those constraints, the different products and different experimentations will have to be run to figure out what is going to fit for the SME ecosystem. And that also, if you think about it, Elroy and Hemant, right,
Yeah.
is a huge opportunity, right? Banks have made existing tech investments, but when we clearly know that these the structure of the current structure does not actually help us get to that objective, win that objective, right? So further tech investments will have to be made by these institutions, and I think that's an opportunity for a lot of tech companies like us, not just in the amongst the banks but also amongst NBFCs, right? There are a lot of tech companies that are providing very interesting solutions to change the shape of the credit to the needs of the customers.
So thanks for joining us and shedding light on the intricacies of the co-branding product and the future of credit, and also how it will impact the SME segment as well. And in case our listeners are interested in getting in touch with you or Hyperface, what will be the best way to do that?
So I'm available on LinkedIn. My name is Ramanathan RV. So my profile is also Ramanathan RV. So you can just go there and search for it. You can write to me on email as well. I'm available at ram@hyperface.co.
Got it. Excellent. So Ram will include those details and also a link to the report in our show notes. Thanks once again for speaking with us, Ram, and all the best for the future.
Thank you very much. Thanks, Heyman. Thanks, Elroy.
That's it from India FinTech Diaries for this week. Do log on to our website, indiafintechdiaries.com, for show notes and other exclusive content. Until next time, stay safe.